Did you know your life insurance could be hiding tax surprises that could cost your family thousands of dollars? Or worse, disrupt the legacy you've worked so hard to build? Let me show you how to avoid those pitfalls. Today, we're going to be talking about the good news and the real shocker, how the IRS can take your life insurance payment. Hi, I'm Tia, and we've worked with hundreds of families to ensure their financial plans stay intact and stress-free. Today, we're diving into the shocking truths about life insurance and taxes. By the end of this video, you'll know how to protect yourself from costly IRS surprises. Okay, so the good news first. Most life insurance payouts are tax-free for your beneficiaries. That's why life insurance is such a powerful tool for financial planning. But here's the reality of it. This statement simplifies a very complex topic. So here's a simple explanation for you. First, if the life insurance policy is owned by your estate at the time of your death, the proceeds can be included in your taxable estate. For example, if your estate's total value exceeds the federal estate tax exemption limit, currently at about $13.6 million for individuals as of 2024, those proceeds could be subject to estate taxes, and this reduces the amount your beneficiaries receive, as taxes have to be paid before distributing assets. It's also important to note that the federal estate tax exemption limit may change, so regular reviews of your plan are very essential. Here's one way to avoid this. Transferring ownership of the policy to an irrevocable life insurance trust, or ILIT, when done correctly, this removes the proceeds from your estate, protecting them from estate taxes and ensuring your beneficiaries receive the full amount. Here's a real-life example. Let's take David, a high net worth individual who transferred his $5 million policy into an ILIT. So when he passed away, the trust distributed the full $5 million to his heirs without any estate tax deductions. 3 important caveats to consider before transferring your ownership. First, transferring ownership means you lose control of the policy. So the trust becomes the owner, and the trustee manages it based on the trust's terms. Okay, second, there's also the 3-year rule. If you transfer an existing policy to a trust, it must be done at least 3 years before your death to keep the proceeds out of your estate. And finally, state laws and federal changes could impact estate tax thresholds and strategies, so make sure to check with a professional for the most up-to-date laws. Now, let's talk about situations where life insurance isn't tax-free. These often involve cash value policies, so here's 3 scenarios where you can be surprised by a tax bill from the IRS. First, if you withdraw from your policy's cash value, you might owe income taxes on the gains. For example, Anna withdrew $100,000 from her policy to fund her small business, and $30,000 of that was taxable because it represented investment gains. Second, if you have unpaid loans from the life insurance policy, this can reduce the death benefit and potentially trigger some taxes. Third, exceeding IRS limits turns your policy into a modified endowment contract, or MEC for short, and this changes its tax treatment, making withdrawals taxable and subject to any penalties. So a modified endowment contract happens when you put too much money into a permanent life insurance policy too quickly. So think of it like this. Life insurance is meant to provide protection, not act as a tax-free savings account. So if you overpay premiums beyond the IRS's allowed limits within the first 7 years, this is called the 7-pay test, the policy changes from a regular life insurance policy to an MEC. So be really careful with this. Okay, so here's 3 steps you can take to avoid any IRS surprises. First, if your policy is owned by your estate, consider transferring it to a trust. This keeps it out of your estate and prevents it from being subject to any estate taxes. Next, understand the tax implications of borrowing or withdrawing before taking action. A little planning now could save major headaches later. And finally, please work with a tax professional or a financial professional to ensure your policy aligns with your financial and estate planning goals. Everyone's situation is different, and this video is not enough information for you to make an educated decision on what should be done. And if you're looking for help, please reach out. At Trailstone, we believe life insurance should be a source of protection, not stress. So if you're ready to take control of your financial future, give us a call now.